Hello, I'm Stephen Grocott, Managing Director of Queensland Pacific Metals. Thank you to the organisers for the opportunity to present to you, albeit virtually, unfortunately, because of border closures. First slide is obviously the obligatory legal disclaimer, but I'll translate that for you. We are very enthusiastic about our project, and it's up to you if you want to share that enthusiasm. On to the first slide of substance though, just summarising the Townsville Energy Chemicals Hub project. Firstly, we're importing nickel laterite ore from New Caledonia, a jurisdiction that's exported ore for about 100 years or so. It's shipped to the port of Townsville, the same port that has been receiving that ore for many, many decades, to the former Queensland nickel refinery operation. We process it through a technology which has been well piloted and tested using commercially proven unit operations. That's the direct nickel process. We produce a number of products and byproducts and co-products. The first product is a mixed nickel cobalt hydroxide precipitate, abbreviated to MHP, a product which is saleable in its own right. We then refine that through conventional refining processes to high purity battery grade cobalt and nickel sulfate. We also produce co-products, hematite and magnesia. We don't do anything special to produce those. They are just the naturally occurring byproducts of this direct nickel process. High purity hematite, which is once agglomerated, is easily sold into blast furnaces. We also produce an aluminium hydroxide byproduct that we intend to refine to a high purity alumina. So in summary, we're exporting ore from established mines that have been operating for many decades, a safe tier 1 jurisdiction, New Caledonia, French territory. We use a very clean processing technology. We recycle our acidic leaching agent. We use off-the-shelf commercial equipment. We have no mine, so we're fast to market, and we're value adding and producing high purity products that plug straight into the EV sector. So if you want to invest in the EV industry, this is as close as you can get to without being involved in the battery or electric vehicle game itself. Those credentials attracted the likes of POSCO and LG Energy Solution. So this month we signed an equity investment agreement with them for an investment of US $15 million. That gives them a combined roughly 10% share of the company. It's associated most importantly with a binding offtake agreement for about 2/3 of our production. So we have got our production tied up with a binding bankable offtake agreement. Now, I don't know any junior company that's got one deal like that with such a high quality partner, let alone having two of them. They conducted a very thorough due diligence study that went for many, many weeks. I don't know how much it cost them, but it was a lot of money, I'm sure. So they are world-class bankable offtake partners. And it's a vote of confidence in the project, the management and the opportunity. But you don't have to believe me. These are their words. We didn't write them for them. They are their own words. So LG Energy Solution, who was a spin-off from LG Chem, they're currently going through an IPO at the moment. These are their words. So it's a very meaningful investment for them. And POSCO are also very well known in the battery game, less so than LG. LG, the world #1 lithium-ion battery producer, but POSCO is very significant supplier in its own right and a major resources company. One of the things that attracted them was our green credentials, our ESG credentials. And the first one I'll cover is CO2 emissions. I'll jump straight to the table. So carbon dioxide emissions or greenhouse gas intensity expressed in kilograms of CO2 emitted per kilogram of nickel produced. So for the global average for nickel metal is about 13 kilograms of CO2 per kilogram of nickel produced. That excludes Chinese producers because they don't supply the Nickel Institute with data, unfortunately. Most of the world's nickel production is actually, however, in the form of ferronickel and nickel pig iron, much more greenhouse gas intensive, 45 kilograms CO2 per kilogram of nickel. For nickel sulfate, which is the product you need for batteries, the global average is about 24, again, excluding Chinese data. The tech project is about 15 kilograms per kilogram of nickel in the form of nickel sulfate. So it's already 1/3 lower than the global average. So it's a real positive. The other sustainability tick for us is that we don't produce tailings, and therefore we don't have a tailings dam. Now compare that with nickel sulfide projects, and particularly for high pressure acid leaching projects. The latter produce 1.2 to 1.4 tons of tailings per ton of ore that they process. We produce 0.2 tons of an inert filter cake per ton of ore. And that inert filter cake is actually being examined as a cement additive or cement substitute, or as an engineered landfill. So it's possible that we could not just be 0.2 tons per ton, but we could actually be a zero solids discharge, or also a zero process liquid discharge. So we have substantial green credentials. But one of the main things is, of course, that this is plugging straight into the nickel growth sector for electric vehicles. This shows a Bernstein projection for nickel consumption in the electric vehicle industry, lithium-ion batteries, showing it growing to somewhere between 500,000 and 2 million tons, conservative and optimistic. Take a mid case, call it 1 million tons of nickel consumed by the electric vehicle sector by the end of this decade. Mind you, Tesla alone, their projection alone was for their own consumption was 1.15. But set that aside, we're talking probably at least 1 million tons of nickel a year for batteries. People have not really got this. I mean, the growth scenario for lithium and graphite and cobalt is great, no question about it. But people haven't caught the picture for nickel, because sitting underneath this is 2.5 million tons of nickel production for stainless steel, and a lot of that in the form of nickel pig iron and ferronickel. That nickel can't readily be converted into battery grade nickel. It's very expensive to do it. People have thought, well, there's 2.5 million tons and you're only growing this bit on the top. No, the truth is that you've got very little sitting underneath here. So your CAGR is around about 30%. So it's a substantial growth sector. Now, so where is all this nickel going to come from? You can read the text yourself at a later date, but I'm just going to highlight some of the key options here that people have thought about. Firstly, the nickel pig iron and ferronickel that I've talked about. It's technically possible, but economically difficult. Your incentive price, depending upon who you believe, is certainly north of US $20,000 per ton. It's got a very ugly environmental footprint, and you would struggle to sell that nickel and cobalt sulfate into the North American and European battery markets. So cross that off. Nickel sulfides or mixed sulfide precipitates can and certainly is being converted into battery grade nickel sulfate. No question about that, but there's not many good sulfide deposits available in the world, and it's complex and difficult processing. So there's not enough to go around. Nickel metal can be converted to nickel sulfate. It costs you 50 cents, $1 a pound, but you still need some nickel metal for stainless steel and alloy production. So this is just robbing Peter to pay Paul. High pressure acid leach, which is much talked about. You can definitely produce mixed hydroxide precipitate and battery chemicals from HPAL, but it's a very difficult process. Most of those processes have failed miserably. There's a couple of good ones going around, but they are challenging to get right and have a very long ramp up. Complex technology. Mixed hydroxide precipitate refining. Absolutely, you can do that. That's commercial and widely practiced, but where's the MHP coming from? It comes from HPAL, so it's a catch-22. So obviously, we think our tech project using the direct nickel process is a great option for filling this looming nickel gap. This just shows a slide with our pilot plant in the background showing our first production of mixed hydroxide precipitate earlier this year. The pilot plant ticked all of the boxes that we need to once again prove up this process. Pardon me. It had already been piloted 15 to 20 times by Altilium Group, formerly known as Direct Nickel, back nearly 10 years ago. So it was well proven. It was just the wrong timing for the project because there wasn't a battery market available. The time has changed, and we just confirmed through a couple more pilot plant runs using our ore in another pilot plant run to produce on spec, in fact, high quality mixed hydroxide precipitate. The next slide just shows the whole pilot plant. It was a very big facility. I also described that as our $6 million photograph. Pilot plants are expensive to run. That was run at a scale where the scale up to a commercial plant was only about 2.5 to 4,000 fold, which is quite a low scale up factor. Typically for hydrometallurgical plants, 2 to 20,000 is used. So this is down at the lower, safer, lower risk end. So we've got a great ore supply, got a great technology, got great sustainability credentials. We also have a great team. I won't speak about the guy on the left. You can form your own opinion, but the rest of these people, I can vouch for their internationally recognized credibility and capability. I'm delighted that we've been able to secure such a phenomenally capable team in projects and on the technical side. This is John Downey, our founding managing director. So the next thing, great ore body, great process, great sustainability, great team. What about the location? And location is just as an important factor. You couldn't ask for a better location. We're 7 days shipping from New Caledonia into the port of Townsville. That port imported 2.5 to 3 million tonnes of ore a year for about 30 years from the same mines that we are sourcing our ore. We are only consuming 1.5 million tonnes a year. Our site, the Lansdowne Eco-Industrial Precinct, zoned heavy industrial. It has the Flinders Highway, rated for B triple trucks, passing along its eastern boundary, and the railway line and the North Queensland gas pipeline. Here is the water pipeline. Over here is a 400 megawatt solar PV array. Honestly, it's a bit harder to find anything better than that. We're so close to Townsville, which has a very high skilled labour workforce looking for work. So great location. Very, very happy with that. I've already covered all of that. So it ticks all of those boxes. The other thing that holds up projects is obviously approvals. We are well advanced in our approvals process. Obviously, we're clean and green. Our sustainability credentials, environmental credentials are quite exceptional, and we have no mine or no native title. So the approvals process is relatively straightforward, and that should be done by the end of this year. And we recently signed a cultural heritage management agreement with the Bindle people, and we hope to be able to be providing them with substantial employment opportunities. In terms of our schedule, I mentioned our piloting finished earlier this year. Project approvals process actually started last year, should be complete by the end of this year. Our feasibility study, we engaged with Hatch. We chose Hatch because they have global credibility. They're a very high quality engineering and construction organisation to work with. Very pleased to work with them. Primarily based out of Brisbane, but also using people all over Australia and from their global networks. That feasibility study should be complete by the first quarter next year. When we started discussing with LG and POSCO, they said, can you make this bigger? And we said, absolutely, we can make it bigger. In fact, bigger is actually better because it's more capital efficient. And they said, can you do it faster? We said, we can do it faster, but then your feasibility study is going to cost more money because you do a feasibility study faster. You run the risk of some re-engineering work, and you need to parallel some of the engineering design, detailed design, if you want to do it faster. So we said, that's going to cost more money. You need to have some skin in the game. So in March, we went and raised 20 million at market, and they've just come in with 15 million US. So it's a shared funding of an accelerated feasibility study. And we achieved the acceleration by engaging early with the vendors and starting the detailed engineering work early as well. We'll start a formal debt process in a couple of months' time. And assuming FID, a final investment decision around here, we've got construction complete by the second half of next year and first production by the end of, sorry, not next year, second half of 2023 and first production by the end of 2023. So, you know, we're a junior company with a market cap of a couple of $100 million. How do we fund this thing? So firstly, on debt, our analysis and the analysis of others shows that we've got we can support a debt capacity of around about 2/3. We're obviously looking to organisations like NAIF and Export Finance Australia. We should tick all of the boxes there, but we'll wait and see. We're in discussions with them. Also, obviously, the banks that we're talking to, perhaps not the Australian banks, but the European banks, especially the French banks, are very comfortable with this sort of project to supply their battery supply chain, and also the French banks because of the tie-up with New Caledonia. There's obviously international export credit agencies and other parties as well. The possibility of offtake financing, but you know, there are many, put it this way, there are many options available for providing that debt, and those discussions are underway. Obviously, equity is the first question that people ask us about POSCO and LG. You don't expect them to sign a check for 100 or 200 million now. That's a discussion that occurs later in the feasibility study and in our discussions, no doubt, with them when we visit them in Korea next month. Green funds out of Europe in particular, you know, for production that meets the battery passport standard that they're developing. So there are many funding options there that we're comfortable with. In terms of a corporate overview, this shows our growth in share price, market cap over the last year. This is primarily due to, along the way, we've said what we're going to do and we've ticked the box. Then we've said what we're going to do and we tick the next box, and we've just kept on doing that. Obviously, the latest box that we've ticked is the binding offtake agreements, and they are binding offtake agreements. There are no CPs there, apart from we need to be producing on-spec product. So we said last year, that's what we were going to do, and we've just completed that. So that's just another tick. So just in conclusion, summarising things, we think we've got a great project from existing mines into an existing port, into a zone heavy industrial region where we have a great project to plug into the growth sector for the electric vehicle industry. Thank you very much for your time.